Welcome to the Multifamily Investor Nation podcast. With us today is Chihiro with Blackriver Equity Partners Group. Welcome to the podcast, Chihiro.
Hey, thank you very much, Dan. I appreciate you having me on.
Yeah, well, I'm looking forward to diving into this deal. You have this deal, which is a 128-unit apartment community in Abilene, Texas, called Riatta Ranch Apartments. But before we start diving deep into that particular asset and acquisition that you had recently done, I want you to give us a little bit of a background about you as well as your group.
Yeah, happy to do that. So I graduated from business school, UCLA, the Anderson School of Management in 2015, and went straight into the corporate world working in analytics, and quickly realized that I really wanted to diversify my income stream and really solidify my retirement, decades in advance for myself and my family. So did some research and really quickly found multifamily being the right avenue to pursue. Now that's the easy part. The hard part was actually getting started and getting into it. But that journey started in 2017, in January of that year. And then it took me right around 2 years of making mistakes and just trying to get my footing and getting this deal under contract.
Was this your first deal that you had under contract?
Yeah, that's right. It was my fourth or fifth offer, but it is the first deal that I got under contract, yes.
Okay. And so how many deals did you analyze before you put those four in actually?
Man, a lot. So by my estimate, I did go back and check, and it was about 150 deals that I had analyzed.
Wow.
Yeah.
That is pretty amazing. So how did you come across this deal?
This was a fully marketed deal, so it just came through in an email blast, just like every other deal. But if you look far and wide enough, you will occasionally come across one where the numbers really jump out. And so saw the opportunity and decided to take advantage and throw my hat in the ring.
So this is a 128 unit complex that was built in the 70s, early 70s, 1973. And so, with this particular asset, when the broker sent you the email, was it one of those deals where you went through, toured the property, did some offers, and then got into best and final and that kind of process?
Yeah, absolutely. So it started out with just the numbers looked good to me. And the first kind of key step was my meeting with a property manager who was looking to aggressively expand their management portfolio. And so I was having drinks with an acquisitions guy at that firm. And he said, "Hey, we're looking to expand. Do you have anything in the pipeline? I know you're aggressively going after stuff." And so I said, "Yeah, there actually is this deal I'm looking at in Abilene. Haven't toured it yet, but the numbers look good." So that night or the very next day, I sent the deal over to him, and he said, "Well, yeah, this thing does look pretty good on paper, so let's get out there." And they were kind enough to tour the property with me and kind of start the due diligence and acquisition support process.
So once you actually got the email from the broker, it was one of the first kind of steps that you took was underwrite the deal, and then you found the property management company, and then they basically toured it with you.
That's exactly correct. Yeah.
Wow. So let's take it back just for a minute here and talk about the broker, because a lot of times we kind of gloss over that piece of it. But how did you reach out originally to this broker to be able to get onto that particular email list?
I found it's not that difficult to start getting on brokers' email lists, but it's not necessarily so easy to get their attention. I think in general, if you just ask a broker for their pricing guidance on a listing, they're pretty quick to respond to that. But you do have to demonstrate credibility. So I would say you ask intelligent questions to demonstrate that you do know a little bit about what you're talking about, and just continue establishing rapport with that broker so that they will take you seriously when it does come time to tour or further investigate the property.
Yeah, I mean, I think, I talk a lot about what I like to call the language of multifamily. It's like speaking any type of foreign language. You have to really immerse yourself into a lot of, training and knowledge, and surround yourself with people that talk multifamily, because, the multifamily language can, if you understand it or don't understand it, can make or break your relationships with multiple types of, people that could be potential on your team. And then one of those are those brokers.
Absolutely. Yeah. Couldn't agree with that anymore, Dan. What I would say specifically helped me in that relationship building part of the process was I did join a mentorship group. My mentor and partner is a gentleman by the name of Mark Kenny, who established this group called Think Multifamily. And so early on in any discussion with any broker, I'm pretty quick to bring on, hey, if I end up being awarded this deal, I'm going to be partnered with somebody who has a well-known reputation of success and has a sizable portfolio. And this person is going to be partnered in the deal with me. And so I definitely know that has bought me a lot of credibility in talking to brokers.
Well, that was going to be my next question is how you were able to kind of, bolster your credibility when really this was your first deal.
Yeah, so having Mark as a de facto member of the team is number one in terms of credibility. But in this particular instance for this deal, I actually ended up partnering with another person who also has a very strong reputation and a sizable portfolio. His name's Will Crozier. And so, and he happens to own in this market, Abilene, Texas. So I had confidence that I would be able to find somebody to partner with in addition to Mark to kind of round out my management / leadership team. But there was some, I had to lay it on the line. Like I had to have confidence that the deal was good enough such that I could bring an experienced co-GP along with me. So I didn't have Will on the team with me at the time of offering, but I think it was at the accepted LOI stage that I started kind of shopping it with a small number of well-respected and well-known, accomplished syndicators that I trusted, and was fortunate in that I was able to partner with two people who were really strong.
Mm-hmm. So you were able to tour this property before you got it under LOI, obviously. And when you guys were touring this property alongside your property management company, were there any kind of like, I always call them yellow flags that you might have been like, oh, I need to make sure we investigate that a little bit further?
Absolutely. The biggest issue with this property, yellow flag, I like that, was plumbing. So roofs are in decent shape. They're only 3 years old. Interiors are actually pretty darn well taken care of. And they're also pretty consistent in quality as well, which as operators, you and I appreciate, right? It's not like a piecemeal interior where you have great quality and poor quality. It's just, they're all pretty consistent. So there was a lot to like, but plumbing was a concern. And we had luckily some not necessarily boots on the ground, but just some connections that happened to let us know that there might potentially be some plumbing issues. So we certainly took the time and the effort and the money to look into that during due diligence to verify what exactly the condition of the plumbing was, and then to determine what exactly the cost of all of that was going to be. Aside from that, though, the property was in pretty decent condition.
How many other people were bidding alongside you on this one because it was a marketed deal?
I'm not 100% certain on that, but I believe there were about 7 of us in best and final.
Okay. Wow. That's still quite a bit in best and final. Usually they kind of whittle it down like the top 3 or 4, but 7. I mean, so how many do you think was overall? You think maybe like probably 30 or 40 on a deal like this?
That's a good question. I should ask the broker. I don't know the answer, frankly.
That'd be a good thing to kind of, I mean, it's always just interesting to know who's actually competing in that market with you and stuff like that too, especially over time as you decide to, bid on more properties in that particular market. You can kind of see, how many people are bidding in Abilene, and kind of see, is it getting more of a hotter market or kind of cooling down? But you had 7 of you in best and finals. So what was it that, the seller decided to go with your group instead of another of the other 6 groups that were competing for this particular deal?
Well, I definitely think a key part of that was the strength of the partnership group, with Mark Kenny at that time having about 4,000 doors under ownership, and then Will Crozier, the same, about 4,000. And then Will eventually ended up bringing his partner, Jason Sharp, on board as well. So there were 4 of us, and I think it was execution certainty, honestly. When you have names like that on an offer, you can be pretty sure that the deal is going to close. So I would have to imagine that the seller and the broker were, took a liking to that for sure.
Mm-hmm. Yeah, for sure. So basically, it was surety to close at the end of the day. Do you think that, or do you know if there were anybody that offered more than you but they didn't really know if they were going to be able to close or not, or?
I do know that we were the highest bid, but there is actually an interesting kind of twist on this part, Dan. So our initial offer was 5.3 million on this property, and after we submitted our offer, that was on a Thursday, and on a Monday, I get a call from the listing broker, and I felt confident in my bid, but I could tell immediately from the tone of his voice, he's like about to give me some bad news. And I'm like, oh no, I lost the deal. Well, it turns out the seller made a big strategic blunder in that they forgot to let the listing broker know that there was a LURA in place on this property on 45 of the 128 units. So this deal was fully marketed, and the broker just had no idea because he wasn't notified that there was a LURA on the deal. So it was once the buyer pool had been whittled down to the best and final that all of us found out that there was in fact a LURA in place.
So explain to the listeners what that is.
Yeah, sure. A land use restriction agreement, wherein there's an income component wherein if you are a potential resident, you can't make above a certain amount in order to qualify for a rent-controlled unit. So you might be restricted to making either 80% or 50% of the area median income. And if you can prove that in your income documentation, then you qualify for lower rent units that are, whose rents are restricted by that LURA. So in this instance, what we did was we went back to the drawing board, and we just re-underwrote the deal with these restrictions in place. And it turns out that the in-place rents at this property are low enough that we're not even approaching the LURA limits. In other words, we can still raise rents all across the board on this property, including the restricted units, and we would still have no negative impact on the top line revenue for the property. So long story short, there was no negative impact from a revenue standpoint as a result of this LURA. So we stayed in the deal.
So it just sweetened it for you.
It just sweetened it for us, because what ended up happening is a few people then dropped out at best and final because they were scared of dealing with the land use restriction agreement, and yet they apparently didn't bother to do the math and see that there was no negative impact on a revenue basis whatsoever. So that turned out in our benefit, and ultimately what we did is we reduced our offer price from 5.3 to 5.2, and yet we still won the deal.
No, that's great. That's a pretty interesting twist there. So with the LURA, are you also restricted on a raising of rent year over year basis as well, or is it just based on the median income?
Yes. So the rent restriction is going to be tied to the CPI index, which is Consumer Price Index. That's just a inflation index that the federal government releases. And so when that goes up, then our rents tie to that and they will go up. So generally, we talk to a property or our property manager. They manage over 1,000 Lura units nationwide, so they're familiar with it, and their assessment was that typically those rent restrictions, they do go up by about 2% a year. So that's what we underwrote in this deal.
And so it sounds to me like it wasn't all of the units that were under that. Is that correct?
That is correct. 45 of the 128, about a third.
Okay. And when does that Lura expire?
It's out of our timeline, our horizon. So it expires in 15 or 16 years, and we've got 10-year debt on this deal. So it'll be in place.
Okay. So the expected hold time on this one was 10 years?
Expected hold is 5, but we have 10-year debt.
Oh, okay. All right. That makes sense. So the expected year hold is 5 years. You said you originally did 5.3, but you ended up with the 5.1 purchase price, correct?
That's right.
And when you were going through the offers on this thing, did you have to put any earnest money up or anything?
Yeah. So we had if I remember correctly, we had a 30-day due diligence period. We put up 75,000 refundable earnest money up front. Then that went hard after 30 days. And then we extended 30 days from the initial 60-day contract period, and then went in another 50,000 earnest money, not a fee, a deposit.
It just went towards the purchase price to extend it.
Correct. Yeah.
Did you have to execute that one?
Sorry?
Did you have to execute that extension?
Oh, yes. Yes, we did.
Okay.
Absolutely.
So you did so it was basically like a 90-day close.
Actually, we ended up extending even further. All in all, we did 3 extensions, including the one we just mentioned, and it took about 3.5 months on this one. Primary reason for that being we had a change in property manager. So this property manager that I've mentioned was extremely helpful during the acquisitions process and during due diligence. But as we brought on our 2 additional partners, we realized there were some, they wanted more local presence from the property manager, and the property manager that I initially had engaged doesn't have any properties in the Abilene market. So we ended up changing during the, while we were under contract, we changed to a property manager that currently has 3 properties in the Abilene market. So that ended up delaying our closing because we kind of had to start over from an underwriting standpoint with regard to the lender.
So how important is that to have a property management company who has a presence in the market versus maybe utilizing a property management company that might be in a city a couple hours away?
Yeah, so the main concern there with a property being an outpost or a frontier property for a PM is that when the inevitable emergency happens, like a major sewage backup or fire or some other such emergency, the original property manager, their closest staff was going to be in either Dallas, which is about 2.5 hours away, or in Austin, which I believe is about 3 to 3.5 hours away. And so we decided as a partnership team that was a bit too much of a risk to carry. And so we made that difficult decision, but ultimately I do believe it was the correct decision to go with a locally present property manager.
So which one of the property management companies walked all the units for you while you were in the due diligence phase?
It was the original one. And because we did switch, that ended up being a cost for us. You know, commonly property managers will waive due diligence costs if you're going to engage them for the management. But in this case, they helped us with due diligence and walked all units, but didn't get the deal. So we did at closing pay them for the services rendered.
Yeah, and that's typical. If 'cause sometimes that does happen where you have to switch, and so usually when you first engage them, that'll be in the agreements that here's the predetermined amount per unit walk for the walks and various things like that. So, but that's good that you guys were able to fulfill your end of the agreement on that piece of it to be able to when you guys switched them out.
Yeah, it was still a painful process. I mean, they're wonderful people. It was certainly nothing wrong with them or their company. But it was a difficult decision, but the right one ultimately.
So you're in due diligence now. What kind of issues came up in due diligence that kind of, that you had to deal with?
Yeah, so we paid to scope every single sewer main on the property. There are 10 buildings on this property. And we did find that with near certainty, we were going to need to replace 2 of the sewer mains. So we went back to the seller and we provided them the reports that our plumber provided to us and asked for a credit. Which we were able to secure a $100,000 credit at closing. So that further reduced our purchase price now down to 5.1. As I earlier mentioned, we were pleased with the interior conditions. They're consistent in quality and fairly well taken care of. There is some carpentry work to the tune of maybe 35 to 40 grand in stucco work that we need to do. Some woodwork and then some exterior painting, but all in all, we're pleased with the quality of the asset. Foundations were fine as well. So
explain a little bit about whether because there's 2 different options here when you find stuff. There's probably really 3, but one is you can go back and retrade on price, right? And there's a couple ways you retrade on price. You can either ask for a credit at closing or have them reduce the purchase price. So you're saying that you actually got a credit at closing. So you paid 5.2, but then they were able to give you $100,000 to be able to do those renovations or to be able to change out those sewer lines?
I think effectively it was a reduction in purchase price. It was just on our closing statement as a credit to the buyer. Okay. And we were transparent with our lender as well. So they were aware of that as well. Yeah. As I understand, there are some situations in which a buyer might try to conceal that from the lender and then try to get greater proceeds and use that to their advantage. But we're trying to build a lifelong business and lifelong relationships here. So we were transparent with our lender and mortgage broker on that point.
Sure. So this is a 1973 bill. There's other things that that might concern you on this. Like maybe some polybutylene piping or maybe even some asbestos on the property. Do you guys do any investigation on those routes?
We don't have poly pipes, but we do have asbestos. So our residents, when they're signing a lease, they're going to have to sign I believe it's a waiver, some sort of documentation regarding asbestos on the property.
Okay. But that wasn't really that big of a concern because I'm sure probably a lot of other properties around that vintage and that class and that market are similar.
Absolutely. Yeah.
Yeah. And if you do a lot of research at all on asbestos, it's usually not a problem unless it's airborne. So unless somebody's moving things around and rummaging things up, it's usually not an issue.
Mm-hmm. Yep.
Yeah. So speaking of the lenders, like you were just a little bit ago, let's talk about that for a minute and describe, how you financed this deal.
Yeah, we did a Fannie Mae affordable loan. So we qualified for an affordable loan because of the LURA. So that is yet another unexpected way in which the LURA actually ended up helping us. So that knocks a little bit off of the interest rate, either 20 or 25 bips, as I recall. Wow. And then we got That's 3 years. Strong. Yeah, we got 3 years IO and a 10-year fixed rate loan from Fannie Mae. Without the ability to do an affordable loan, if that were off the table, then we would likely have needed to go with a Freddie Mac loan, which the terms wouldn't have been as favorable as Fannie Mae.
Would have been like a Freddie small balance or something.
Yeah, perhaps. I'm not sure exactly what, but yeah, when our broker was sizing up the loan initially, before we knew about the LURA, he was thinking we would go with a Freddie Mac loan.
Mm-hmm. Yeah. Great. So 3 years IO, 10-year fix. What rate did you get on this one?
We locked at 4.87.
Just pretty solid, pretty nice. And on this particular, did you go through a broker or did you go direct?
We did go through a broker, Anton Matley, with Peak Multifamily Funding.
Okay. Yeah, I think we actually, you and I were at an event this past weekend, and actually at the Think Multifamily event, and he was there as well.
Yeah, that's right.
I got to meet up with him, so that was kind of cool. Now I get to know who you're talking about.
Yeah.
Great. Well, so how did you structure the deal here with investors?
This is a 75-25 straight split. There is no pref, and there's no acquisition fee. In fact, there are no fees at all, save for a 2% asset management fee. So it's a pretty straightforward capital structure that I like because it's really easy to explain to people. Being that I am a first-time syndicator, my investors are also first-timers. And so it would be a little more challenging to explain waterfalls and prefs and that sort of thing. So I thought it worked out nicely for me as a first-timer.
Mm-hmm. Now, you plan on staying that way?
I'm certainly not married to it. I'm willing to consider any sort of structure. But this was the preferred structure of two of our partners. So we went with that because this is what their investors are most accustomed to.
Mm-hmm. Now, obviously, you being, this being your first one, your partners were the loan guarantors primarily on this one, as far as, meeting certain lender requirements, stuff like that. Were there any loan guarantor fees or anything like that?
No. They certainly did guarantee the loan, but or not guarantee it, but they signed on it. But yeah, no fees.
So they got nothing upon closing. It was really only whenever the asset is sold.
No, they're getting a portion of the GP for sure.
Sure.
They're in the deal with me, but yeah, we didn't have any fees in the deal aside from asset management.
Okay. Oh, I see what you're saying. Because you're going to still get the cash flows because there's no pref that you guys would be able to split,
Correct.
year by year with the investors.
Yes, that's right.
Whatever the cash flows are is 25%. Now, as far as the GP is concerned, who's doing most of the asset management?
So I'm going to be the point on that as I was through due diligence. But I've got the guidance of my mentor, who's going to be on the asset management, the property manager calls with me. And then for any sort of major decisions, certainly I'm going to loop in all of my partners. But one thing that I really appreciate about everybody I partnered with on the deal is we were very clear from the very beginning who was going to be doing what. I was going to be running the deal, but as a first timer, I need help raising capital. So two of my partners were going to raise the lion's share of the capital. I would raise the rest. And then from a mentorship or hand-holding standpoint, my mentor would take care of that.
Mm-hmm. How many investors do you guys have in this deal?
We have 36.
36. And how much was the raise?
The raise was 2.8.
2.8 and 36 investors. And was this a 506B or C?
This was a B. So we did have non-accredited investors.
Now, are you looking to stay in the 506B realm, or are you going to consider going into the 506C?
Oh, I would absolutely consider both options. I I think that what's important with this business is to be flexible. So be it capital structure or which Reg D exemption we're going to use, I aim to be flexible with regard to all of that.
Mm-hmm. So are you, what would make you decide between a 506B and a C, like moving forward on a future deal?
That's a good question. I don't know that I've put a lot of thought into that, but I would certainly consider a 506C deal.
Mm-hmm.
It would probably involve discussion with my partner or partners, and which offered the best opportunity for capital raising for us.
Sure, sure. And there was another question I was going to have for you. Oh, how long did it take you to raise the 2.8 that you were raising?
I believe it was about 2.5 to 3 weeks. It was I was pretty pleased with the progress. I have to thank my partners for that. As I mentioned, they raised the lion's share of the capital, so they were machines. I mean, they raised capital. They have reputations that are very strong within the investor community. So I benefited from that.
Sure. How many, what percentage wise of the 36 investors that are in this project would you say are accredited versus really what's the kind of percentage split? I know you don't know the exact number, but off the top of your head, kind of if you throw in a little throwing a ball at it, I guess, like taking a guess at what the percentage split would be between accredited and non-accredited.
I did have the number at one point, but I don't have it committed to memory. But as I recall, it was probably between half and 2/3 were accredited.
Okay.
Yeah.
The majority of them were accredited.
Yeah. Yeah.
And, I think that's sometimes the best thing to do especially on a first deal, is to start with that 506B, because a lot of times you're going to be able to get those families and friends that might not necessarily be accredited, but they still know you very well and are comfortable investing with some of your projects. So did you have some of your own family and friends that were able to, put some money into this deal?
Yeah, absolutely. So I had one family member, my father actually, invest in the deal. A couple people from my undergraduate days, and then the majority of people were my business school colleagues, and then also one professor from my business school days as well.
That's
So
pretty
that's
cool when your professor, I guess, invests with you, isn't it?
Yeah, he is quite well known in real estate, kind of a real estate celebrity, frankly. And I feel very fortunate that he put his faith in me and this deal. So, yeah.
Yeah. That is pretty cool. That's pretty cool. So I have another question here about what kind of issues did you see that came up throughout the entire process that maybe we haven't hit on yet?
One thing that really blindsided us and did result in us needing an additional or a final contract extension was insurance. So what we're finding is on renewal, in this state of Texas and perhaps elsewhere, on renewal, these premiums are going up a lot. So based on the T12, the property was paying about 32 or 33,000 a year for insurance, and then we got a quote from the same agency, and we ultimately have 42,000. So it literally went up $10,000 from one year to the next.
Wow.
And so we were expecting the insurance to come in at 42 because that's what we were quoted. But then deep into the contract period, when we were looking to get final numbers from the insurance broker, they gave us a quote for 45 just out of nowhere. So, the lenders are underwriting on a very tight margin. So when we had them crunch the numbers, that was going to equate to about $35,000 less in loan proceeds, which was going to be a big hit to us, So we had to kind of fight that fight. And ultimately, we did successfully negotiate that back down to the originally quoted 42,000. But that certainly delayed us and ended up requiring an additional 5 or 6 days extension on the contract period.
So each time you extended it like that, did you have to pay up additional earnest money that, to be able to extend it?
No, fortunately, this seller was very easy to work with. Really, just wonderful people. So they were very understanding. I think it helped that we were very transparent with them as well. Yeah, luckily they were willing to work with us and very understanding.
Yeah, that's great. So two final questions that I have here for you. So the last two questions that I always like to ask is first off, what was one thing or a few things maybe that you found that was easier than you had expected throughout this entire process that maybe you thought was going to be a lot harder?
You know, one thing that you don't know until you do is acquire an apartment. I had done a whole lot of underwriting, and I'm certainly no pro at it, but I had done a lot of it and felt fairly comfortable doing that. But then, there comes a moment where you're like, oh crap, well, now I have a deal under contract. What am I going to do? But once you're in it, it turns out not to be that bad. It's a lot of administrative work, frankly, herding of cats at times, but you just have to be on top of it as a project manager. And as long as you do that, it's really not too difficult. In my opinion, the difficulties in getting a deal under contract and more importantly, finding a deal that is underwritten conservatively and projects to provide returns to your investors. That's the hard part.
I was going to be my next question is what did you find that was harder than expected throughout this process?
Raising capital can be a difficult thing. And that also is something that, you're just never going to be able to know it until you actually do it. And so I did come across some objections that, I felt like they were unfounded. One, for example, was, well, Chihiro, you don't have very much experience in this. And I'm like, yeah, I don't, but I've got partners who've acquired over $500 million in apartments. So I feel like we have a pretty strong leadership team. But, the reality is when a potential investor brings up some sort of objection, even if it's unfounded, their mind is made up. So there's no arguing that point. You just have to let it go, let them go, and hope that eventually they'll come back around and be a part of your team in the future on another deal. So those conversations sometimes can be tough because you feel like you're so close to securing some capital and then they fall through, but you just got to move on.
That's great advice. I get that a lot with some of our investors where they ask you some questions and they decide not to invest. But the biggest thing is tell them the truth, be honest with them, and if they decide to pass on this deal, there's going to probably be a point in time where they have that fear of missing out of another future deal that you have, and they'll want to invest alongside you once they start seeing you put some projects together because everybody has a different threshold of comfortability in investing with various people.
Yeah, absolutely. The one thing I'll add to that is timing is also truly of the essence. A lot of people are, they may have invested in the deal just last week, so they're not in a position to invest with you today. But you just have to keep those relationships going. Like you said, be honest, be transparent with people, keep them in the loop, and hopefully they'll come back to you in the future.
Well, Chihiro, I want to thank you so much for taking some time out of your schedule to be with us here today. How can the listeners reach out to you if they want to get some more information from you, talk to you a little bit further about this Riatta Ranch deal that you had in Abilene, Texas, or maybe even be able to sign up on your investor list for a future deal that you have put together?
Yeah, absolutely. My website is blackriverep.com. That's Blackriver EP, as in equity, P as in partners. And if you go to that website, you can just sign up on our list, and I'll provide you a free little PDF that I've put together that provides you the 5 main benefits of investing in multifamily.
All right, great. Well, thank you so much. And we'll make sure we put that link in the show notes for all the listeners so they can have easy access to it. And again, look forward to having you on a future episode of the Multifamily Investor Nation podcast as you close more deals.
Thank you very much, Dan. It's been an honor. Appreciate it.